Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin from apexinvesting.com. Today we're going to briefly talk about trading the morning session using Nadex binaries and spreads. And we're going to go into how to choose the intraday or daily binaries and spreads, and particularly we're going to go into using the news to know what to trade, knowing where to exit, where to take profit, and how to do limit orders. So the first thing is knowing what the morning session is. So the trading sessions for Australia are 5 p.m. to 2 a.m., 7 p.m. to 4 a.m. for Japan, 3 a.m. to noon for Europe, and 8 a.m. to 5 p.m. for North America. Feel free to pause the video here so you can write these down or take a screenshot of the slides so that way you have it for future reference. So the first thing you're going to look for is news reports on FX pairs during those times of that session. And you want to look primarily for heavy impact reports. And you want to look for when two countries have a lot of reports at the same time. For instance, the US dollar and the Canadian dollar will often have a lot of reports happening at the exact same time, like at 8:30. And that can be a time that causes a lot of volatility in the US Canadian. So that could be a time that you could look to trade the news using Nadex with defined risk. Another example is a lot of times people want to trade stocks. Well, you could trade Google by trading its earnings release by using the Nasdaq, because Google obviously will often move the Nasdaq quite a bit, and you can use the US Tech 100 whenever Google releases earnings. It's just one of many examples that you could look for in the market. There are a lot of different calendars out there that you can take advantage of. We have a calendar built right into our free member area website. Right under helpful links, you can choose economic calendar A or B, and what you'll notice right here is that we can see, like tonight, the Aussie dollar has the employment change and unemployment rate coming out. So that'd be an opportunity to trade in the evening or, with a morning session for Australia, depending upon, what the morning session is for you. Now, if we scroll over and look to tomorrow, we can scroll down and we can see that the US dollar is going to have multiple reports happen. And in particular, we can focus right here on the USD Canadian and notice all these reports happening basically right at the same time. And you even have the ECB press conference happening. So adding further volatility to the euro dollar, which will add volatility to the dollar, which will add volatility to the dollar Canadian. So that right there gives you a lot of opportunities. And you can see the interest rate decision coming out right there on Europe. So that's basically their Fed funds rate. And the pound dollar also has its interest rate decision coming out at 7 a.m. Eastern time. So there's multiple reports lining up that makes it pretty easy to figure out what it is that you want to trade. Now, when you click on any of these reports, you can go in and you can see the history of the report as well. And we'll come back to the history of the report here in just a moment. So first you got to figure out, what do you want to trade, binaries or spreads? Do you want the intraday binaries or do you want the intraday spreads or the daily spreads? And basically what you'll have to do is look at, when you're comparing the intraday versus the daily, will the news impact the trade soon enough, or is it a news report that sort of takes 3-4 hours before it fully comes into effect, or does it happen within a matter of minutes? The intraday are going to give you lower premium, higher payout with less time requirement compared to the dailies. And then you want to compare the risk versus the reward, such as are the intradays giving me better, or the dailies giving me better? Are the spreads giving me a better risk reward, or are the binaries giving me a better risk reward on the trade? And then stick with one of them on a consistent basis till you get it down. Then you can expand further into doing spreads and binaries. But I'd probably suggest that you. All right, we'll go back to FX history here in a minute. But right now, let's go ahead and focus on what instrument vehicle do you want to trade? Do you want to trade like the FX binaries or the FX spreads? Do you want to trade the intraday binaries or the intraday spreads, or the daily binaries or the daily spreads? So when you're looking at that, you want to know, will the news impact the trade soon enough? Because you need it to move fast enough if you're going to use an intraday binary and intraday spread. It may take more time in order to see the result of the announcement. In that case, you'd want to go in and potentially look at the daily. And then you want to look at the risk versus the reward. So is the risk okay on the dailies, or do you need to go down to intradays? Is the risk okay on the binaries, or do you maybe need to look at the spreads? So which one gives you the best risk reward? And if you're confused and you don't have both of them down, just pick one, such as a binary or an intraday binary or a daily binary, and narrow it down from there. And as you progress in your trading, you can add in looking at the spreads and the binaries. So pick one of the two, master that one, and then add in basically to your trading vehicles that you can take advantage of on these types of trades. So when you're considering binaries, it really depends on the expected move and what price it's available at. A binary in the money can move, against you, and some you could still profit, or it could stay flat and profit, or go in your direction and profit. One that's right at the money, a very small move, could make it profitable. And out of the money will require more move, but will also have less risk and more profit. And there's a lot of strikes, even on the dailies and the intradays, that you can take advantage of. And that often can be a big consideration when looking at the binaries, is all the strikes that are available. When you're looking at a spread, you usually want one that's in the money or very close to the floor or ceiling, because a small move will help you get to break even faster. And a large move will make you more money than a binary will in most instances. But a medium move will work better on a binary. So, you may or may not want to use a spread. It's really just going to be based on the risk reward that you're looking for. And so you want to compare the two, again, the binary versus the spread, once you've mastered both instruments. And one of the biggest things you need to keep into consideration is the distance to break even is more important than the risk on the spread. Because sometimes people go in and look at a $5 risk on a spread, but it has to move 10 points to get there. So you definitely want your distance to break even. Where's the market at versus where's the spread priced at? And you want to consider that whenever you're choosing what spread you want to choose for trading the news in the morning. Now, one of the things I mentioned was looking at the FX history. And you can go in and you can look at history right here. Like I said, just click on any one of the announcements and you can click history right there. And you can look at, additional history. And here's the big advantages. What happened when they met the expectation? What happens when, they didn't meet the expectation? If it was better than last time, worse than last time, if they lowered the rate, raised the rate, whatever the difference is. But you want to look at that, and then you can look at the date right here. What date was it actually released? And it'll be released at the same time. So look at the date and the time. That'll allow you to go back on charts and see how the FX market actually responded to that news announcement. And you can find out usually what the best one to trade is by doing that. So did it go up, or did it go down when it met expectations, or if they were missed? Did it go down if the expectations are exceeded? Did it move immediately and keep going, or did it take time to make the move? Did it move really fast in the direction of the news, do a pullback, and then retrace back to the high or the low that occurred off the news? Well, then you could get in on the pullback if that's a consistent pattern. So how far does it usually move in all the above? Also look at other reports that happened in the past and how an index moved or how an FX pair moved at that time. A few of the things that's good to keep note of is to look at how the report did compared to the last report. Were there revisions on the report? Because sometimes they'll revise the last number. You'll see a number come in bad, and you're like, why in the world did that go up? But you look at the revision, and they revised the last number a whole lot higher. And a lot of times that's why that happens. Also, how did it compare to the same time last year? And then what's really important, were there other reports released at the same time? Was it good news? Was it bad news? Was it, neutral? Did it possibly go in the opposite direction, like you had a good and a bad report come out at the same time, so it just muted the entire impact? So you want to be able to look at all these factors. It is some homework, but by doing the homework and doing this over the course of about 3 months, you can have a trading book for the entire year for trading news reports, and you know what to trade it on, and you know how it moves, and you know exactly when you're going to trade it. So you can literally have your entire trading book for the entire year planned out with a few months of work where you're going in and analyzing the different reports that come out every day in the markets. There are a few different strategies that you can look at. So you can look at strangling before the news. So the risk would be, both the binaries or, both the spreads if you're straddling. And the reward, one thing you need to understand is the reward's on one side. The risk is both sides. So if I have $10 risk on one side and $10 risk on the other side, then I have a $20 risk total. So I want to be able to make $20. So if I make the $10 back on one side that was at risk, I need to make another $20. I need to make $30 to have a 1-to-1 risk-reward ratio on the trade. So, or maybe you want to be directional before the news. You have an opinion, you want to take it, and the cool thing about Nadex is you can go in and you can do that. You can be directional, and you can't get stopped out on a spike, because sometimes it'll spike down and then fly in the direction you think it's going to go in. And even if it does go against you, then your risk is capped. So you don't have to worry about, stop losses being blown right past and having, stops missed and jumped and things like that. So your risk will never increase past your original defined risk when you put on the trade. You also may want to be directional after the news. Some news reports take longer to affect the price. And so a news report comes out good, moves a little bit, you hop in, and it keeps moving over the next 30 minutes or hour, and you're able to just go in one direction so you don't have to put money on both sides of the trade. And then you have the option of the direction on the pullback. So it pops up, it comes back down, you get in, and you get out when it gets back up to that high or that low that it was at right off the news. Again, I want to remind you, we want to look for a 1-to-1 risk-reward ratio or better, meaning the expectation on how far you think it's going to move. Do you have the ability to cover all of your risk and ideally make that same amount of money in a profitable trade? The next thing is you need to have proper expectations. So not only do you get proper expectations from looking at things historically and how has the market responded to that news announcement on that FX pair or on that index or on that commodity, but how far does the market expect that market to move today? Well, how do you find this out? Well, what you need to do is be able to pull implied volatility from a number of options. Implied means expected, volatility means movement. And by pulling that out of the options of the underlying market, then you can then factor it into a intraday deviation formula, and you're able to access how far the market's going to move today based on the market's expectations. And there's a lot of different ways to get this, but one of the ways to get it is inside our website. You can get it for free. Check it out right under here under deviation levels. And we post these each night and on all the Nadex markets, and we even have a little section where you can highlight. It tells you what the underlying market contract symbol is, which is very handy, and what the month is for that contract right now. And it shows you, say, what a 1 deviation move is. So if you're looking for a 1 deviation move, that means you think it's going to move 12 points. Maybe you're looking at the Aussie dollar. Well, that means you think it's going to move up or down, 44 pips. So you can be looking at a strike up and down 44 pips away from where the market is at that time. Or if you're trading spreads, you can be looking to take profit when it moves up or down 44 pips. So knowing that that's where you want to take your profit, does your risk and reward give you a 1-to-1 risk-reward ratio? Now, there are 3 prices that you can count on with binaries. If a binary is out of the money at expiration, it's going to be worth 0. So if you bought the binary and the underlying was equal to or less than the strike, it'll have a value of 0. If you sold the binary and the underlying was greater than the strike price, it will be worth 0 at expiration. Now, if it's in the money at expiration, then it's profitable. So if you buy the binary and the underlying is greater than the strike, okay, then it'll be worth $100 per contract. If you put up $20 risk and it's worth $100, you made $80 profit on the trade. If you sell the binary and the underlying is less than or equal to the strike, then it's a profitable trade. If it's at the settlement, if the underlying market has settled less than or equal to the strike on a sold binary. Now here is the third piece, and this allows you to not simply put on binary orders, but actually trade binaries. With the Nadex exchange, you're able to get in and get out of a trade before expiration. Okay, this is a huge advantage. What you're able to do is go in, and at the money basically means the underlying is at the same price as the strike. So if the Aussie dollar was trading at 1.0400 and there was a binary strike at 1.0400, then you would be able to go in and basically buy or sell that binary for $50. Now we got to go in and we have to take in the reality that there may be, a couple dollars bid-ask spread. So that's going to put us at right around, say $48 to $52. And personally, one of the things I think is wise to do is, it may not exactly hit your strike. Maybe it gets like 5, ticks away or something. And so what I like to do is I'll go in and I'll usually, maybe if I'm going to buy it, I'll buy it like at, say $10 or $20, and I'll sell it $43. So, or I'll sell it $10 or $20 and buy back at $57 on the binary. So one thing that you can count on, again, is that when the binary is right at the same strike there as where the underlying market's currently trading, it's going to be right around $50, and you can get out when it gets there and set a take profit order. Again, do not hold the binary to expiration when you're doing a trade like this. The out-of-the-money binaries, basically binaries that have a risk of less than, say, $45, you really don't want to be looking to hold those binaries until expiration when you're doing a trade like this, because you're expecting it to move so far, but you have no idea where it's going to be at expiration. So The strategy is you exit when it hits the underlying strike. And again, always go back and look at your risk-reward analysis. Now, as soon as you get filled, then you're going to enter a take profit order. So when you get in, let's say you buy on one side for 10, you sell on the other side for 90, so you have a $20 risk on the trade. Then you want to go to your open position tab inside the Nadex platform and click on the green arrow right next to the open position. And then adjust the price and click submit to submit your order. So as an example, let's say we went in and we bought this one right here for a $10 risk. Okay, bought one contract, we'll hit place order. And then we sold this contract right here for about a $10 risk. We'll place that order. And this is a good example because what you'll notice is sometimes the market will move between when you click on it and it places the order. So just click on the working order, and then you can edit it by, if I'm buying, I want to click on the right side here, okay? So click on this, it'll update the price automatically for me, and click amend order. So now I'm filled on that order, and I basically have risked about $20 on the trade, okay? Now I want to be ready for the news announcement that's going to be coming out. So I can go over here, and I can click on this, and if I sold it, okay, then I want to buy it back for about $53 to $57, okay? So say buy it back for $57. If I do that, then that means on that trade, my total risk is approximately $20, okay? But on that trade right there, I would make a little over $35 on the trade. So I go ahead and put that order in there, and of course I'd lose the $11 on the bot side if the market went down, all right? And so I'd still net over $20 of profit on the trade if it does actually move down and fill that order. Now on the other side, I can click right here, and I bought this one for $11. I can go in and put an order to sell it for $43. That would allow me to have about a $32 profit if I bought at 11 and sold at 43, and then I lose about $8 over here on this side, so I'd still net more than my $20 risk, so I'm still exceeding that 1-to-1 risk-reward ratio. And so by putting that together, now my working orders are filled, and I can walk away, and the trade is there. I can come back and I can edit it if I want to, but the trade's on, and the take profit orders are in, and so if the market explodes in one direction or the other, then I already have my take profit order set. So as a summary, you want to look at the trading session, focus on the Forex pairs in that session, or possibly commodities, depending upon exactly what you want to trade. Look for high-impact expected government news. Analyze the history of that news report, and then keep that log. Like put it in an Excel sheet, put it all together, so you have it going forward. You don't have to reanalyze the same report over and over. Choose a strategy, such as getting in before it, getting in after it, or straddling it on a spread, or strangling it on a binary. And just make sure that whatever strategy you choose, you got a 1-to-1 risk-reward ratio or better on the trade. And once that's there, then choose your strikes and your take profit areas based on something like deviations. And on the binaries, exit when it hits the strike. On the spreads, set a take profit order, or you can babysit it if you want to trail the stop. But it's always good to have at least some sort of take profit order in there, just so if it moves really fast and pulls back, which happens a lot on news, then you're prepared and ready and you're able to take advantage of that nice, fast move. To open a live or demo account, simply go to nadex.com today and get set up. Also, visit us over at apexinvesting.com to learn more about how to trade on Nadex.